I have Henry Hager here with me, who's in New York City right now, right?
Correct. Good morning, Denny.
So good morning to you, and a couple of words about yourself and about our discussion today. So you're managing director at Waterous Energy Fund, and we spoke about it. We met actually a couple of weeks ago, and you have a very interesting background. So before joining the fund, you were a director at KKR, where Henry spent 6 years with particular focus on energy and infrastructure. Before that, he was with Constellation Energy in its corporate strategy and development group, where he was involved in a number of merger and acquisitions and other corporate advisory transactions. Also served, we talked about that, in a number of capacities in President George W. Bush's administration. I was mentioning to Henry that our first Dallas conference was at the Bush Library in Dallas with Ken Hirsch, that opened the conference, really. And last year, this year, sorry, with Tremel Crow and many other great folks from Dallas, we did our event there at the Bush Library, which is a beautiful, beautiful place. So back to this. Served in a number of capacities in President George W. Bush's administration, including as a West Wing associate at Karl Rove, senior advisor to the president, and at the economic and energy policy advisor to the 35th Secretary of Commerce, Carlos Quintirez. He also served as deputy operations manager on President Bush's 2004 re-election campaign. You studied at the University of Virginia, where you got your MBA and BS from Wake Forest University. He's on the board of the George W. Bush Presidential Center and the Building Conservation Trust. So that's in a nutshell, of course, and we will talk today, obviously, about the current opportunities in oil and gas. You know, when we wrote that sentence, it's funny, that headline, amid market volatility, we had no idea what we're talking about, because when you and I, Henry, looked at this headline, the market was way more stable than it is today, maybe several weeks later. You know, what's going on in the stock exchanges. I was just doing an article, by the way, that's saying that, you know, families don't really have anywhere to go. I mean, most of us don't. I mean, you put money in cash, you lose. Stock exchange, you lose. Blockchain, you lose even more. Corporate bonds will be soon dealing with probably Chapter 11s coming with the recession. Government bonds are hurt by inflation. Housing is hurt by inflation. Houses are still expensive. Inflation is higher. It's a mess out there, and I think families are looking for more, you know, interesting places to put their money, because otherwise they'll be losing it. So again, back to our headline: current opportunities in oil and gas amid market volatility, a geopolitical risk, and rising interest rates. And we just had a 0.75 hike yesterday, so I think it couldn't be more right to talk about this now. I mean, things are just getting worse since you and I spoke all around the place. So hi.
Denny, thank you for having me. Thank you for that kind introduction. Thank you for supporting the Bush Center and holding your events in Dallas. It's a fantastic presidential library and you know, policy do tank, as President Bush likes to call it. He's not a big fan of think tanks. He likes to get out there and really be engaged in changing policy for the better. So it's a pleasure to join you. And like you said, there's a lot going on in the markets right now. I don't think we can cover it all, but we've been investing. I've been investing in energy for over 15 years and really caught the bug when actually during my time at Department of Commerce, working with Secretary Gutierrez. I was doing economic policy for him and trying to figure that out. That was a big task. I was in my 20s, and they said, you know what, you're doing a pretty good job. Why don't you take on energy policy as well? And I fell in love with energy, mostly because there's an impossible trinity of energy, is the way I just try to simplify everything that's going on today or over time. And at the time, you know, the shale revolution was just kicking off. Nobody was talking about it. It was obviously 30 plus years of innovation to be able to develop the technology to extract resource from horizontal, horizontally, drilling horizontally and completing wells. But that was just kicking off at the time. So this is 2004, 2005. But the impossible trinity of energy is, and this is so important. There's three things you can't have in today's world. And quite frankly, I'm not sure we're ever going to be able to figure these out. But energy cannot be cheap, clean, and reliable. You have to give on something. And maybe with technology, we can figure that out. And I think we need to figure that out. It's going to take time, but you know, the closest we might come is nuclear. So once the facility's built, then we might get to micro turbines, but you have very cheap baseload power. So it's extremely reliable and it's cheap. And that's great. That's what creates human prosperity. Energy drives human civilization, period, full stop. But, you know, you have two problems. On the clean side, you've got fuel. So spent fuel has to be disposed of properly, or else it creates a lot of harm. And obviously security. So while that plant is operating, it needs to be very secure, both from an operations perspective, but also from a you know, somebody trying to attack it or hack the facility. But you know, aside from nuclear, you could just go through everything, right? So solar and wind, not reliable. It's an intermittent source of power. We've developed the technology to the point where it is becoming cheaper and is sometimes displacing the marginal cost of power. But you know, there's a huge carbon footprint to developing solar arrays and wind farms, whether we'd like to believe that or not. And then these parts break down all the time. It's a huge maintenance issue. And then of course you got to dispose of these old things when they become obsolete. But it's, you know, so it's clean in some respects. It's not necessarily reliable, and it can be cheap. It's getting there. So you could just keep going around the circle and look at all sources of energy, and we can talk about oil and gas today. So we'll dive into that, but that's a good snapshot, in my opinion, on how to think about both the problems and the opportunities and solutions.
Thank you. I have several questions that I think I'll ask after you give us a little bit more information about how you see the world, where do you see the opportunities, what's going on, and how, you know, Ukraine and everything really that's going on in the world today affects your space. So maybe we'll start with your presentation and dive more into details.
Thank you, Denny. I'll pull that up. Let me share my screen. Hold on one second.
Yeah.
So I'll just maybe a little quick background on us. So I work for Waterous Energy Fund. Otherwise, for short, we call it WEF. Waterous Energy Fund is a private equity firm. It was formed in 2017. As you mentioned, I previously worked at KKR in energy, and the team is there's three of us from KKR, and then the founder, Adam Watrous, who has a 30-year career in energy, mostly on the banking side, is the founder of the firm and based in Calgary, Canada. And another gentleman from his previous banking experience at Scotia Watrous. So Scotiabank bought his investment banking firm called Watrous & Co. In 2005 and kept him on as the global head. So that's his background. And he formed the business. And I was working with his son, Connor Watrous at KKR. Really what we have a thesis and a strategy in the oil and gas marketplace, but just quickly, here's a snapshot of effectively what we've done in the last 5 years. We've raised 2 funds in 2 co-invest vehicles, and those are fully deployed. It's about a total of $2 billion of equity deployed, and those are in Canadian dollars, and you'll see that on the right-hand side of the graph on this slide. So effectively fully deployed on the capital front. And then what we did was through 13 transactions, we built one operating company in the oil and gas industry. And that company is called Strathcona Resources. And so most private equity firms have diversified portfolios. So, in this particular example, one way to think about this is we would have 13 different portfolio companies, 13 different management teams, 13 different capital budgets, maybe 13 different basins in which we operate. But the opportunity we saw in 2017 was that what had transpired in oil and gas up until that point was most private equity pursuing this industry were doing so with a growth equity strategy. So backing management teams with a technical thesis on how to de-risk a particular basin or section of a basin, subset of a basin, and private equity managers would give that team capital to go try and de-risk with their technical thesis. And so, at the time in 2017, there were something like 500 private equity-backed oil and gas companies just in the United States alone. Very fragmented industry, and that growth equity strategy was really, hey, we're going to drill a lot of wells. We're going to spend a lot of effectively R&D dollars. So it was really a venture capital strategy, in my opinion, not a private equity strategy. And when we prove out our thesis, we'll sell the company and there'll be a large capital gain at the end. And it was just sort of like a trust us. I know we're outspending cash flow, but we'll get there. And that's, you have growth equity strategies in lots of different industries. We've seen growth equity in a number of industries in the last few years that in today's markets are very challenged as well. So it's the same playbook, but that's what was transpiring in oil and gas in 2017. And so what we wanted to do was pursue an equity payout strategy. So we wanted to buy what we called trophy assets. And there's a quantitative definition of trophies in terms of the way we screen assets and companies. High returns on capital employed, great margins, i.e. very low full cycle break-evens, very long reserve lives. Will you be able to develop these assets for a very long period of time, and low natural decline rates. So, the shale industry was you bring these wells on at really expensive costs. They come on very strongly, very high rates, and they decline very rapidly. We were trying to buy assets with very low natural decline rates, and that takes out a lot of capital risk. And so we're trying to de-risk in our investment strategy. That's the capital risk. So when you have low natural decline rates, your maintenance wedge to keep the asset flat on production is very small. And then on the technical side, we were buying established assets and businesses, so stuff that was already on production, but had room for growth and development, but were very well understood from a technical perspective. And so that de-risked the technical risk of the assets themselves. So buying established businesses. And then the question is, the trick to buying trophies at good prices Price is what you pay, value is what you get. If you want to buy a trophy, if you want to buy Fifth Avenue real estate, or take your pick of your definition of a trophy in a different industry, to get that at a good price, we were pursuing these through complex situations. So a lot of hair on these. We executed asset purchases out of bankruptcies. We did prepackaged bankruptcy purchases, and we actually had a direct to shareholders in the depths of COVID in 2020 to buy a company. So here's our timeline of all of our transactions on the top, going back to the start of 2017. And you'll see we were active right up until the most recent asset purchase was the Tucker asset from Synovus in January of this year. And then we merged Caltex and Tucker, two companies that we bought, one at the end of last year, one at the beginning of this year, into Strathcona in March. So one company, Strathcona Resources, producing 110,000 barrels of oil equivalent a day. It's the 7th largest oil and gas company in Canada, the 6th larger, and that's by production or cash flow. You can look at it on a number of different metrics. The 6 larger are all public, and we're really excited to have consolidated and built scale. That scale allows us to get access to capital, which has been on retreat from the oil and gas industry for the past few years. And as you can see in the little green box, both on production reserves, we've got 30% and 25% CAGRs on a per dollar invested basis, which is to imply these are accretive acquisitions as we've gone along. So that's what we've been up to. We've been very busy, and we continue to remain very excited about the opportunities that we see today, and I'll come on to that here with some other slides. Here's just a quick snapshot on our performance. I don't want to imply that our numbers are better than anyone else, but it's always nice to kind of see just on a graph that over the last 25 years, and we think that's a really important period to contemplate when thinking about investing in oil and gas, because as you can see on the far left-hand side, extreme outperformance of oil and gas really took place in the late 90s, early 2000s. That's a really important historic kind of context, because if you go back to public company earnings transcripts in the late 90s, early 2000s, which was around the time your friend Ken Hirsch, who does a fantastic job of running the Bush Center, started NGP, Natural Gas Partners. And the outsized returns in the late 90s, early 2000s, companies were talking about not growing production, returning cash to shareholders, and kind of hunkering down. And that's a lot of what you see happening in the oil and gas industry today. They're not incented to grow. And that's, I think, one of the big problems we face today is, ultimately, these higher prices we see, we need more supply of oil and gas. We need more refined product. And the industry is not being told or incented to spend that capital to grow. By the way, the industry is coming off a few terrible years. Obviously very challenged through 2020 and the pandemic on the production side. So if you think about the U.S. oilfield services industry, it's largely gutted. Rigs were cold stacked, parts were taken off of them. They're 3rd generation technology now, and the rig hands went to go work in Texas real estate, building homes. So you have an industry that's largely gutted and has to be rebuilt, and that's going to take time. But massive outperformance in the late 90s, early 2000s. And as you can see, we're in the green bar. We are performing well in historic context, and the best performing fund with the 2017 vintage. If you think about demand for oil in the world today. On the left-hand side, we're back to pre-COVID levels on demand, and oil demand is very highly correlated with GDP growth and human population growth. Again, energy, cheap, reliable, and/or clean energy, which is impossible, but is what drives human prosperity. And you'll see, obviously, in the second quarter of 2020, demand was down massively compared to the previous 100 years of sort of following GDP growth because of the lockdowns and the pandemic. And then it bounced back rather quickly. And in the green there, you'll see that for demand forecasts, we're going to be back. If we're pretty close to 2019 levels, and we'll be back to 2019 levels probably by the end of this year. There's not a whole lot of spare capacity in the world on the supply side, which is what's driving prices. So you'll see in the gray bar, there's only about 2.5 million barrels of spare capacity. It's all in the Middle East, arguably all in Saudi Arabia. And even that number hasn't been necessarily tested in the past. We came pretty close at the end of 2019 into the first quarter of 2020 before the lockdowns. But the market is very tight, and you see that in the pricing. When you have very high prices on the front end of the oil curve, going lower out the curve, the implication is, hey, we need more supply right now today. That's what we see in the markets. On the right-hand side, this is a very common graph that folks I'm sure have seen. But this just tracks basically per capita liquids consumption versus GDP by country. Very highly correlated. And you'll see that the energy privileged world, so the Canadas, the United States of the world, we believe have a moral responsibility to produce more oil and gas for the energy impoverished world. And so we'll come on to this concept. We call it LEEP. And this is what we is a really important part of our overall strategy as we look to invest in this space. The LE of LEEP, LEEP, is lower emissions. So at Strathcona, we're looking to lower emissions every day. We have over 40 projects in our queue to do that. So decarbonizing effectively the oil and gas industry is imperative and will remain important basically for the duration. And so we're very focused on lowering emissions, but then the EP is energy poverty. So we think it is, we have a moral imperative, as I said, to help deliver cheap, clean, reliable energy to large parts of the world that simply don't have any energy supply at all. On the supply side, this is, I think, decently well understood. But again, like I said, the industry is not, and this is globally, by the way, the industry is not receiving the signals and the support to grow supply, which is very necessary right now. So what you see on the left-hand side here is in the red graph is S&P 500 energy trailing 12 months CapEx. And so, as we all know, oil prices basically halved at the end of 2014 into 15 and 16, and you see CapEx following that, just falling off a cliff. And the industry has only basically continued to reduce capital expenditures. And so, that's a long period of time. That's 7 years effectively of underinvestment. That is coming back to bite us right now. We're feeling that. And The world needs, just an FYI, the industry globally should spend about $500 billion a year just to maintain production flat. That's what we call maintenance CapEx. And while this is just the S&P 500 energy, global CapEx in the oil and gas industry has been materially below that number for a really long period of time. And we're feeling that today in prices. In the blue line there, you see trailing 12 months spot WTI, right? And so oil's up and moving higher since we shared this graph. So this is just through the end of the first quarter. And obviously, WTI is call it 115 today. I haven't checked it since we got on. So it's moved even higher. On the right-hand side, again, like I said about the oilfield services industry, it's largely gutted. As you can see, employment is basically at late 1990 levels. So there was this huge build and growth in the oilfield services industry as the shale revolution effectively took off. And that was a technological disruption. But there's been a material drop in employment since then, or effectively since 2014, 15, 16, when prices came off. Maybe the last thing I'll hit on just quickly, and we'll go back to having a Q&A, Denny. We wrote an op-ed at the end of 2020. It was published in Pensions and Investments, P&I. And it was our thesis was at the time and remains something called peak investable oil. So if you think about the world demands about 100 million barrels a day of oil, of liquids, and supplies about 100 million barrels a day. And those numbers are off today, but this is going back to 2019. So we're going to go back to pre-pandemic to try and normalize. And at that time, there was about $100 million of liquids production globally. We calculated that only about 27 million barrels a day of that global supply was investor controlled, or about 27%. The rest of it was controlled by OPEC and nationalized oil companies. And so there was a security implication, and it wasn't positive at the time. And so this was pre-pandemic. It was difficult to get that op-ed published, but this is a really, really important aspect of the market today, and it's being priced in, sadly, more and more in terms of the geopolitical risk inherent in a barrel of oil ever since Russia invaded Ukraine. And so what we're fearful of is that by 2030, the percentage of investor-controlled production of liquids, global liquids, is going to come down from roughly 27% at the end of 2019 to about 20%. So if you think about investor-controlled oil, right, we're talking about public companies with shareholders and boards in countries with rule of law that have regulatory requirements and transparency requirements. And if you think about European majors, they are selling oil and gas assets and reinvesting that capital into energy transitions and other technologies. And they're usually selling oil and gas to OPEC or to nationalized oil companies. So that's why the percentage of investor-owned oil is going to come down over the next 7 years. And right here, this is OPEC's forecast in itself, which basically projects a decline of US and European oil supply. And they're forecasting production increases from OPEC and nationalized oil companies in Russia, Qatar, and Brazil. So, there's lots of sources for this data, but that is a real problem. And that has global security implications. It has national security implications for the United States. And quite frankly, it's one reason why we've been, we were very bullish on investing in Canadian oil and gas, because They have rule of law. We share a land border with the United States, and as a friendly neighbor that the United States should be developing very strong relationships with for energy security going forward. The last slide here, and this is important because of where we are in the market today, which is, we have rising interest rates, as you saw yesterday, and high inflation. And so you have to go back to the period of 1970 to 1981. And a lot of investors today weren't investing back then, myself included. So if you go back to that period and you study the data, you'll see that energy had the highest correlations to inflation and performed the best from a real return perspective over that period of time. Now, keep in mind that in 1970, 1981, energy was you needed about 3.5 times as much energy to produce a unit of GDP output. So the developed world has become a lot more energy efficient at producing commerce or producing GDP growth today. So it shouldn't be necessarily as challenging as 1970 to 1981. But this is really important from a historic context because you'll see that real returns for large cap equities and U.S. long-term bonds were negative. And you'll see that even for small cap stocks and international stocks, the real return was modestly positive, and U.S. Treasuries was flat. On this slide, all we're trying to show here is energy and technology weightings as a percentage of the S&P 500. And if you updated this for today, this convergence you'd see this convergence continuing, which is to say, energy hit a historic low as a percentage of the S&P 500 during the pandemic of 2% of the S&P 500, and technology kind of peaked out at 28% of the S&P 500. And these are converging quickly. So energy is about 5.5% of the S&P 500 today. And you'll see the historic average is about 8.5%. And technology still remains a very large percentage of the S&P 500 value. And we expect this to continue to converge. On this last slide here, this is the important part for energy in today. Why, you've seen oil prices rally, you've seen natural gas prices rally. Is it over? Is it too late? We would argue that it's not, because you'll see that in the top graph, in the blue lines, the historic upstream EBITDA multiples have actually contracted from 2020 to 2021 to 2022. And so Harold Hamm proposed taking Continental private this week. He's not pleased with how the industry is being valued in the public markets, and he wants to take his public company private. There's still an opportunity here. The industry has not re-rated. Capital still needs to come back to the industry, and we still think we have a good investing opportunity ahead. You'll likewise see in the diamond dots that levered free cash flow yield as at historic highs. So going back to the shale revolution, 2010 through 2016, the industry was largely outspending cash flow, saying, trust us, you'll have a large capital gain in the future. That was in the private equity industry. And this is obviously public data. What you see is that the industry has moved and pivoted to paying out a lot of that cash and having strong free cash flow yield. So that's another reason this industry is so attractive today from an investment perspective. That's all I have on slides, Denny. If you want to move to, do you want to refer to any other slides? Or do you have any questions on those, or do you want me to take those down?
Yeah, I think we can go to some of the questions that we have for you. But before that, maybe you mentioned the fact that we should be working with with Canada a little bit more. And as somebody who's been to the government and knows the system better than most. How come that's not what's going on? Why really isn't the US going to Canada for oil more than it does now?
It's a good question. I think, politics can sometimes get in the way of the right answers and solutions for particular industries. ESG became a very hot topic, and folks are very focused on climate change. And quite frankly, I think the oil and gas industry was a sitting duck target for those claims. If you think about humans' involvement in altering of the climate, a big part of that is the consumption side. We consume all types of resources to live better lives every day. And some of that is driven by oil and gas. And I think the industry was not prepared for that conversation, and they should have been prepared for that conversation. I think they're positioning themselves a lot better. I think they are focused on investing in the right technologies, because we do believe that the industry needs to lower emissions. But let's be honest, nobody's focused on the demand side of this problem, which is the consumption of these resources. And I think, for President Biden, back to your specific point about Canada and the United States, for President Biden to make the determination as president, the first thing he would do would be to cancel Keystone XL, the pipeline, which is a small portion of the pipeline that basically needs to be finished in the United States. The Canadian portion's done. Sends a very, very strong political message, right? That this is the most important. I would argue, if it's your first determination as president, that's the most important thing you think is the case. And that sends a message to the entire world, right? The United States is looked upon for leadership a lot of times in different aspects. And so that's a very strong message that the industry needs to, be wary. And so today, where we find ourselves is an industry that's not investing in supply.
I'll jump to some of our questions, which are basically, I'll start with what really drove you to get into this space to begin with in 2017, right? So basically 5 years ago, why did you decide to get into energy?
Why did I decide to depart KKR?
And build a new business focused on energy.
To build a new business. Really, it goes back to, there's two aspects to our thesis. So, we believed that oil and gas, if you think about the oil and gas industry going back to the 1970s, it was really a resource scarcity argument, right? This stuff's becoming harder and harder to find and replace every day. And so you might as well invest in it today, because it's going to be worth more tomorrow. And that was that resource scarcity thesis in oil and gas really played out for 40 years. That's a long period of time. And it drove a lot of merger and acquisition activity. So large guys would buy medium guys would buy small guys, and then large companies would divest of assets, and you could start small companies with those. But it was really about trying to replace reserves and grow reserves. And you were rewarded as a CEO if you just simply, during your tenure, grew reserves. What happened with the shale revolution, technological disruption creates opportunities, but also challenges. So with the shale revolution, all of a sudden, a lot of companies had massive amounts of inventory. They didn't need to go out and buy companies to replace reserves. They had 10, 20 years of drilling. And so we saw that the merger and acquisition activity in the oil and gas industry was going away. So an industry for 40 years that had been driven by this, and private equity, by the way, was just creating 10 or 20,000 barrel a day oil companies to sell into that into that merger and acquisition activity. We saw that was going away. Adam saw it on the banking side, mostly because what used to have 12 to 15 bids was getting like 1 to 2 bids. But it went from 12 to 15 bids to like 8 to 10 bids to like 5 to 6 bids. And then all of a sudden you're like, gosh, no one's showing up to auctions. Why? We got too much inventory. We don't need to buy that small company. And so there was a massive structural change in the oil and gas industry that was taking place around the time it started before 2014. But what happened in 2014, 15, 16 as oil prices came down. So a lot of people mistook a cyclical change in the oil and gas industry, which is, hey, oil used to be $100, now it's 50. Let's go buy the dip. They mistook a cyclical change for what was a massive structural change in the oil and gas industry that was transpiring. So we saw that as an opportunity to go build a business that was, as I said, looking to acquire established assets in complex situations, trophy assets, and scale, consolidate those assets and delever basically a company.
Now you have a concentration really with your portfolio. You built one portfolio company that holds through 13 transactions, and why is that? Aren't your investors, worried about that concentration?
Concentration risk. Yeah, no, our investors are very supportive, and I think we made that clear early on when we were going to market that. This was part of our thesis that the industry needed to consolidate. You needed scale to get access to bank financing. That became even more apparent during the period of the last 5 years. We needed to take out costs. We needed synergies. This was a highly fragmented industry, and these small subscale companies cannot survive and they cannot sell themselves. So our investors have been super supportive of our strategy. It wasn't necessarily obvious in day one when we built the business and went to go raise capital that was just going to be one portfolio company. It might have been 2 or 3, but what's transpired over the last 5 years has made it abundantly evident that this was the right path forward. And what I mean by that, just to give you like something tangible, in the depths of COVID in 2020, the bank groups in Strath and the bank group of Kona, which are 2 separate portfolio companies, said, we'll actually increase total borrowing capacity of your lines if you combine the businesses, right? So the businesses have naturally hedged assets. And so there was a lot of synergies to forming one business. But we were actually able to increase bank financing in the summer of 2020, which is, I think, less than 5 companies in North American oil and gas, that's Canada and the United States combined, actually got increased bank financing in the depths of COVID.
And I think we talked about it a little bit. How can we address the problems we see in the oil and gas market today? Policy or economic? You mentioned Canada is one of the issues here, but anything else?
Look, I think the industry needs clear regulatory path to operating, and it needs support, right? So, when the UK implements a windfall profits tax on the industry, that sends a very negative message across the world. And you see those types of legislation being introduced actually in Congress just this week on the United States industry. When the president's writing refiners in the United States letters to increase the amount of refined fuel supply to bring gasoline prices down, look, the industry doesn't like the massive volatility of prices. The problem is we've underinvested in this stuff for so long, and now we're bearing the consequences of that. And so the industry isn't necessarily positioned to just go out. It's not holding back supply on purpose to drive prices higher. It needs, these are long lead time, high capital intensive industry. And really since '08, we haven't invested in long lead time capital intensive industries. Think of bridges and roads, infrastructure. You know, we keep talking about how poor the infrastructure is in the United States. You know, we'd rather invest in iPhones, right, than copper mines. We'd rather invest in software than oil and gas production and refining capacity. And that's catching up, and it's really going to bite us. And it's happening in a number of commodities around the world.
Now, one of the things you published was peak investable oil in late 2019. Can you walk us through that thesis and why it's so important to energy security, the percentage of free world oil in small and shrinking?
Absolutely. So just bear with me. Sorry. I think I'm having a little bit of battery trouble here. You know, I hit on this in our slides, you know, but the concept I think is pretty straightforward, which is that, you know, investor controlled oil supply is being underinvested in, and is shrinking and will shrink over the next 7 years. And that's a problem. Most of the
let's see, there's a slight issue here. So I'm sure Henry will join us in 1 second. In the meanwhile, until Henry gets back, I will share with you that what we have planned in the next several weeks. So we have 2 private dinners that we're holding in New York City, one with an AI company and another one talking about the insurance world and the opportunities there. So if anybody wants more information, let us know. That's happening in New York in the next 3 weeks, I believe. And after the summer, on September 15th, we'll hold our blockchain event where we'll be talking about what's going on there, which is obviously a mess. And one of our keynotes would be Alex Mashinsky himself, who's in the center of many headlines now with his firm. November 3rd, we will be holding our event in New York, and
sorry about that.
8 in Chicago. Yeah, don't worry about it. I was just updating everybody on what we have planned after the summer with our conferences. So go ahead.
There you go, Denny. If you don't have reliable energy, you're in for a world of hurt. So I just lost power to my my other form of communication with you in the group, but I'm back.
You are.
There's a real world example of the problems we face, and some folks live in areas of the country and world where they may be facing rolling brownouts or blackouts this summer just because demand's going to be so high, right? So these are real world problems. So I'm sorry to lose you there. Peak, I think we've touched on peak investable oil. We don't need to spend a lot of time on that, but it's just the idea that investor controlled oil supply, which is about 27% at the end of 2019, relative to some ownership of those types of assets from OPEC, nationalized oil companies, we believe is going to decrease to about 20% of global supply by 2030, therefore increasing the energy security risk of the supply of oil and gas.
Now, ESG. Let's talk about that profile of the firm. Tell us more about what you're doing to create alignment to achieve your ESG goals.
Absolutely. So Strathcona Resources produces about 110,000 barrels of oil equivalent a day. That's about 85% liquids, and it definitely has emissions associated with that production. There's a few things we're doing. We have a long list of projects that we can implement at the company to lower emissions, lower water usage, recycle water, and keep, quite frankly, our employees safe and healthy. And that's all really important. One of the things we did was we made health, safety, and environment 25% of all in comp for the leadership team at Strathcona. So you'll hear public companies talk about how they've made ESG or health, safety, and environment 25% of executive compensation. But really what they're talking about is just short-term executive comp, and the LTIP programs, the stock incentives and that type of thing are not included in that. For our company, it's total compensation for the executive team is tied to health, safety, and environment. And so it's the first thing we talk about as a board when we meet. It's imperative that the executive team is focused on that. In Canada, they have a carbon tax. So there's actually economic consequences to emitting CO2. And the way that program works is it ratchets up the price of carbon between now and 2030, while reducing basically your baseline emissions. And you have to prove that you are actually reducing emissions. So it ratchets down the cap effectively, above which you have to pay taxes. So we are economically incented and operationally incentive to always look to reduce emissions. And so I think in the short term, that is one challenge you could view as economically challenged to operating in Canada versus anywhere else in the world. It's the only resource exporting country in the world with a carbon tax. But in the long term, we're actually big fans of it, because in the long term, we're going to have a better positioned company. It's going to be further decarbonized. It'll have implemented technologies. Carbon capture, storage, and utilization is a big topic in Canada. There's a giant project that the majors are going to fund to bring captured carbon down to our Cold Lake area, which has some of the best sequestration rock in all of Canada. Then we just have our assets happen to sit on top of. So we're very well located geographically to be able to capture carbon off our Cold Lake assets and sequester effectively in a different formation right there. The folks that are capturing in the Athabasca oil sands region to the north have to build a pipeline that's 300 kilometers down to the Cold Lake region to be able to sequester. That's gonna take them 7 or 8 years to build that pipeline.
We'll do that a little bit faster because we have a couple of questions, and we're already almost at an hour. Carbon mitigation technology, CCUS, big topic. Can you tell us more about what you're doing to take advantage of this technology?
As I just said, we're looking at technologies to capture. You really want concentrated point sources of CO2 emissions. We have those at our facilities, mostly in the Cold Lake region. Those are our most carbon intensive of assets, to be able to capture that. And then they sit geologically right on top of the best sequestration rock in Canada. So to be able to sequester that without having to transport it a long way is extremely valuable and a strategic benefit to those assets, which we're excited to continue to look after. And like I said, we have about 40 projects in the queue that will help us figure out ways to decarbonize the company. We're building cogeneration power facilities. Some of that comes with government grant money. So the Canadian government is very supportive of providing support to the industry to decarbonize. Some of that's in reduced water usage. Some of it's in recycling of water, and then of course employee safety. But CCUS is this huge concept, right? There's opportunities all over the world that people believe, capturing carbon and sequestering it in rock formations deep underground will obviously reduce the amount of CO2.
and hopefully keep temperatures from rising.
Now, to summarize your key attributes to your approach, we're talking about concentration, yield, inflation protection versus venture capital, growth equity, diversified portfolio with double promoters, capital gains only at the end of the fund. Can you talk about that?
Yeah, look, Strathcona is a business that is on a run rate basis doing something north of 50% free cash flow yield today at today's prices. I'm not sure where else you can find that in the world today. And so we have the business position very well. We're paying down debt this year. We're funding the maintenance capital to hold the assets flat. We're funding growth capital this year at the company. And we have a tremendous amount of liquidity on balance sheet to be able to continue to acquire assets if we can find them at attractive prices. And they have to meet, obviously, our quality screens, that being a trophy asset, but also to be able to get it at a good price. If the M&A, we do see more capital coming back to the space. Some of these processes have been more competitive. If we cannot continue to grow the business through M&A, we can grow the business organically through growth capital, drilling wells. It's highly accretive to do that in today's prices, both oil and gas. And then we would look to pay out a special distribution at year end, or company for other forms of liquidity. But the business is generating a lot of cash today that we can pay out to our investors.
Actually, my last question for you is basically the question that that somebody's just asking right now here. The question is, what do you see gas prices going in the next year, given everything going on? And my question was, what are you thinking about when you look at the energy horizon, which is a little bit broader question, but I guess that's a good. These are good questions to summarize this discussion.
Absolutely. I am not going to pretend to be able to forecast gas prices. So my caveat is, we're not good predictors of where commodity prices are going necessarily. We did invest behind the thesis that the industry was massively undercapitalized, and that was at the time, for some time, creating opportunities on the buy side and to capture that as that reality set in. Commodity prices are extremely volatile, right? And so we continue to think in the short term, it doesn't necessarily make sense for gas to trade at $9 or $7 an MCF, or for oil to trade at $120 a barrel US WTI. So short term, we're sort of pessimistic, if you will, like those prices should come down. We think the marginal cost on oil and gas is a lot lower, and that should mediate. But over the long term, as I said, if you're not addressing the problem, which is a need to invest in the supply of these resources, you're going to have prices move higher, right? And that's against the backdrop, by the way, that rising interest rates, things look unsteady. If you have a recession, that could create demand to come down, which could alleviate some of the price pressure we see to the upside. With gas, obviously, it's a commodity that we're exporting to Europe. Europe, massive gas crisis right now with the Russian invasion of Ukraine. And so, while oil is much more of a globally fungible commodity and more easily traded, gas is getting there, but it has a long way to go in terms of LNG cargoes. And so gas trades more regionally. It has different aspects to it than oil, but we are gas producers, and we remain optimistic, I think, in the long term that prices will remain robust. Possibly in the short term or on the front end of the curve, they could come down. Just because the cost is lower to produce.
Thank you, Henry. Somebody asked here if there's going to be a replay of this session. I believe we will allow it to be at least a week or so. We will send you a link where you could see the recording for those of you who weren't here, and obviously even more so for those who registered but are not here and would like to see that. Henry, anything else that you'd like to add at this point?
Thank you for having me on, Denny. It's been a pleasure getting to know you, and I hope we can all break bread this summer in the area. And thank you for letting me speak to your clients. I know you run a really impressive business, and I hope folks found this helpful. So thank you.
Thank you, Henry. I'm looking forward to seeing you again here, and hopefully at our in-person conferences. We just spoke about how important the in-person life is. I just did a post the other day on all the people who feel sophisticated and efficient that they're at home and they don't get out of the house, and how much they're losing. I took pictures, where I'm at the World Trade Center. I took pictures of Brookfield's place there, outside on the water. Places were packed, people talking to one another. And you and I met in person and learned so much more than we have at our Zoom call. So I'm telling you guys, you may be efficient, but you're losing a lot by not getting to meet people and eat some junk food and not just home cooked great food. So Henry, it's been a pleasure. I'm sure I'll see you at our in-person events. I was just saying when you got off, I was just telling everybody on September 15th, we have our event here in New York, our tech event. On September 3rd, we have our New York conference, our annual one. On November, September 15th, in tech in New York. November 3rd, our annual New York conference. November 8th, our Chicago conference with Sam Zell, Zach Williams, the next gen of the deceased amazing actor Robin Williams, and many others. And November 22nd, London, Sherry Blair will be speaking, and many other great names. And then at the end, we finish the year as we always do during our Basel in Miami, where we pay overpriced prices, overpriced for overpriced food and hotels, but we enjoy art and traffic jams. So Henry, thank you so much. I'm looking forward to seeing you again. Thank you, everybody here. We'll send you this later on. You'll get the information about this session tomorrow after we edit it a little bit. So thank you very much, and stay safe and enjoy life. Have a great summer, everybody. Thank you.
Thank you, Denny.